The next type of adjustment we're going to talk about is called depreciation. Depreciation is a term we use to describe the allocation of cost of an asset over its useful life. We only depreciate long-term assets such as buildings, equipment, and furniture, and the depreciation represents wear and tear and obsolescence of the equipment. Buildings, equipment, and furniture don't last forever, so it does not make sense for us to keep that cost that we paid for it forever. What we do is, as it wears and tears and as it gets used up, we expense it over its useful life. So we assume that a building would last us about 30 years, and then we will spread the costs that we spent for it over 30 years. Whereas equipment wouldn't last us 30 years, so equipment will be spread over a much lesser period of time. Same thing with furniture. We depreciate only long-term assets, and in accounting, we assume land has unlimited useful life, and therefore we never depreciate land. Also, sometimes you see the term plant assets. Plant assets typically mean long-term assets such as buildings, equipment, and furniture. Let's look at an example for depreciation. On 1st of January 2012, Emily and Company purchased $900 of equipment paying cash. On December 31st, 2012, it is the year end, and what is the adjusting entry for depreciation expense? Before we can calculate depreciation expense, we always need to look for certain types of information. And always your questions will provide you with this information, and you need to look for it when you're calculating depreciation. So this question is telling you, assume that the equipment has a useful life of 3 years and has no residual value. Emily and Company uses the straight line method of depreciation. In Chapter 3, we only use the straight line method. Later on, there will be other methods, so you don't have to worry too much about the method of depreciation at this point. But the things that you're going to look for is the useful life, which we know is 3 years, and how much residual value this company has. And in this case, there is no residual value, and therefore residual value is 0. The definition of a residual value is the cost of your asset after you have used it for its useful life. So at the end of 3 years, how much will this equipment be worth? Whatever it will be worth is called the residual value. In this case, it will not be worth anything, so your residual value is 0. Since we're going to move on to another screen, you may want to write down certain pieces of data for this example. We paid $900 on 1st of January to purchase this equipment. The useful life is 3 years, no residual value, and the accounting year end is December 31st, 2012. The first thing we're going to do is record the initial transaction. So on 1st of January 2012, we paid $900 cash for equipment. You know that your equipment increased, your cash decreased, so we're going to debit equipment for $900 and credit cash for $900. Now, the next thing we do is we go to year end, which is December 31st. We need to figure out what is our adjusting entry. To do that, we need to calculate our depreciation expense. Depreciation expense has a formula. Depreciation expense is equal to cost minus residual value divided by estimated useful life. So in this particular case, your depreciation expense is equal to cost, which is 900. There is no residual value, so minus 0, divided by estimated useful life, which, if you remembered, was 3 years. Your depreciation expense, therefore, is 300. And the good thing with straight year depreciation is your depreciation expense is going to be the same every year. So for 2012, 13, 14, you're going to have $300 of depreciation expenses every year. Now that we know how much depreciation expense is, our next step is to do the adjusting entry. Again, I'm not going to show you the journal entry. What I'm going to show you is your T accounts, which is a visual representation of your ledger accounts. Don't forget that. Whenever you're recording depreciation expense, there are two accounts that are affected by that entry. Always, depreciation expense is going to be debited by the amount of the depreciation, which is $300, and then we have a new account which we call accumulated depreciation, and that account is the one that gets credited. So don't forget, even though we are depreciating equipment, we do not reduce the cost of the original equipment. We have a new account which we call accumulated depreciation, and that is the account that gets credited. So for any depreciation expense problem, whenever you have record your adjusting entry, what you're going to do is you're going to debit depreciation expense and credit accumulated depreciation. Your accumulated depreciation is called a contra asset account. A contra asset account is an asset account that has an opposite balance to a normal asset account. You know that asset accounts have normal debit balances. Accumulated depreciation is an asset account with a normal credit balance, and therefore it's called a contra asset account. So if in your exams or quizzes they ask you a question which account is a contra asset account, it would be accumulated depreciation. Now, you know that your equipment is an asset account, your accumulated depreciation is a contra asset account, and your depreciation expense is an expense account. Where would these accounts appear in your financial statements? Your equipment and your accumulated depreciation would appear on your balance sheet under assets. Accumulated depreciation always appears alongside the related asset. We call that a companion account to equipment. So whenever you see equipment, you will also see accumulated depreciation for that equipment, and they will always be shown together. Again, those two, accumulated depreciation is a companion account to equipment. Now your depreciation expense is an expense which will be in your income statement. Now the amount that is shown on your balance sheet is called the book value. To calculate the book value, you take the cost and you subtract the accumulated depreciation. So in this particular case, your cost is $900, your accumulated depreciation is $300, so therefore your book value is $600. The book value will be shown in your balance sheet under long-term assets. So you will have the cost of your equipment, which is $900, less accumulated depreciation of $300, and then the book value will also be shown as $600 in your balance sheet. Now, the depreciation we calculated was for year 2012. Now let's look at the end of the year 2013, which is the second year that your asset is in use. In the second year, again, at the end of the year, you're going to have to do your adjusting entry for depreciation expense. Your accumulated depreciation and your depreciation expense are the two accounts. Your accumulated depreciation account has a balance of $300. That was the depreciation that you credited when you did your adjusting entry. Now your depreciation expense doesn't have any balance. You won't understand why at this time, but by the end of this chapter you will understand why. Just know that the expense accounts do not carry balances. So your depreciation expense account doesn't have a balance, but your balance sheet account, which is your accumulated depreciation, has a balance that you brought forward from your previous period of $300. Now let's do your adjusting entry for 2013. You know that your depreciation expense every year is $300. Once you calculate it once, you don't need to calculate it again. You're going to use it for the length of the useful life. So on 31st of December 2013, you are going to debit depreciation expense $300 and credit accumulated depreciation for $300. Now, at the end of 2013, you have a balance of $300 for your depreciation expense and $600 for your accumulated depreciation. Now, in your balance sheet for 2013, your book value of your equipment would be equal to cost, which is 900, minus accumulated depreciation of 600, which is equal to $300. Let's do the same thing for the third year that we have this equipment, which is December 31st, 2014. Again, you've got your two accounts, depreciation expense and accumulated depreciation. I said that the depreciation expense account does not have a balance, but your accumulated depreciation has a balance that you carried from your previous year of 600. Remember, this is your third year. You had a $600 balance in your accumulated depreciation. Now it's time to do your adjusting entry. Your adjusting entry is going to be debit 300 for depreciation expense, credit 300 for accumulated depreciation. Now let's take the balance on both accounts. The balance on your accumulated depreciation is now $900. Let's calculate the book value. The book value is cost, which is 900, minus accumulated depreciation of 900. It is 0. Your book value is 0. So in your balance sheet for 2014, what you're going to show is that your cost was 900. You've fully depreciated your equipment, so your accumulated depreciation is 900, and therefore your book value is 0. You've depreciated it fully, so for future years, if the company keeps that asset in use, you are not going to depreciate it anymore. You are done with depreciation for this particular equipment. So again, for future years, we do not depreciate this asset once we have fully depreciated it. To summarize, accumulated depreciation account represents the sum of all the depreciation expense that you have over the asset's life. And as the asset's life increases, the accumulated depreciation also increases. The accumulated depreciation is a contra asset with a normal credit balance, and it's a companion account to the asset. And remember, the book value is the cost of the plant asset less accumulated depreciation. The book value of the asset decreases as the asset ages. So as time goes on, the book value of the asset decreases.